Hello students. Today we are going to learn open economy, that is the last chapter of our macroeconomics part 1. First we need to understand as to what is open economy. Open economy is one which interacts with other countries through various channels. So far we had not considered this aspect and just limited to a closed economy, in which there are no linkages with the rest of the world. So we can say that closed economy is one which does not have any kind of transaction or interaction or relations of, let's say, trade or exchange of technology with the other countries. Whereas in case of open economy, it is the one which interacts with the other countries through various channels. Let's say for exchange of technology or for export, import, etc. So there are linkages in the open economy. Now, when we talk about the linkages in open economy, it could be output market or financial market, or it could be labor market, which means that we are talking about the exchange of the output, the finance, and the labors. So movement of goods has traditionally been seen as a substitute for the movement of labor. And foreign trade have influenced the Indian aggregate demand in many ways, or we can say especially two ways. First, when Indians buy foreign goods, this spending escapes as leakages from the circular flow of income, and it decreases aggregate demand. Second, our exports to foreigners enter as an injection into the circular flow, increasing the aggregate demand for goods produced within the domestic economy. So when the goods move across national borders, money must be used for the transaction. And at the international level, there is no single currency that is issued by a single bank. So foreign economic agents will accept national currency only if they are convinced that the amount of goods they can buy with certain amount of money, that the currency will not change frequently. Now, for this, we would be studying about the monetary system and exchange rate. But before that, let's understand what is balance of payment. Now, a country has to deal with the other countries in respect of the following, let's say visible items, invisible items, and capital transfers. So when we talk about visible items, it includes all types of physical goods exported and imported. And invisible item includes all those services whose export and import are not visible. For example, transport services, insurance, medical services, duties, all are these invisible items of trade. And thirdly, capital transfer. Now, capital transfer, which are concerned with the capital receipts and capital payments. So, let's understand what is balance of payment. Balance of payment records all the transaction of these goods and services and assets between the resident of the country and with the rest of the world for that particular period of time. Let's say for that particular financial year. So, according to Kindleberger, the balance of payment of a country is a systematic record of all the economic transactions between the residents of the reporting country and the residents of the foreign country during a given period of time. Now, this simply means that due to globalization, or we can say open economy, there has been exchange of goods and services between the countries. So these transactions of export, import, which are taking place between the countries have to be balanced. And that is why we say that balance of payment has to be balanced. It is a double entry system of record of all economic transaction between the resident of the country and the rest of the world. Now, when we say country's balance of payment, we are referring to the transaction of its citizen and the government. This is another definition. of balance of payment, which says that it is a systematic record of all the economic transactions between the resident of the country and rest of the world. It presents a classified record of all receipts on account of good exported, services rendered, and capital received by residents, and the payments made by them on account of goods imported and services received from the capital transferred to non-resident or foreigners. Now, let's understand what are the features of balance of payment. As we know the definition, it's a record of transaction between one country with the rest of the world. It includes all visible and invisible and unilateral transfers. It relates to a particular period of time, and it adopts a double entry bookkeeping system. So it has two sides, credit and debit. Now receipts are recorded on the credit side and payments on the debit side. Now, we know what is balance of payments, then what is balance of trade? The difference between a country's import and its export. Balance of trade is the largest component of country's BOP, wherein we have two things, debit and credit. And debit item would include import, foreign aid, domestic spending abroad, and domestic investment abroad. Whereas credit items include export, foreign spending in domestic economy, and foreign investment. Now, when exports are greater than imports, then balance of trade is favorable. And if the import are greater, then it is unfavorable. So we can say that balance of payment takes into account all the transaction with the rest of the world. Whereas balance of trade takes into account all the only trade transaction with the rest of the world. So when we talk about importance of balance of payment, it is record of all the transactions that create demand for and supply for the currency. And BOP may confirm trend in economies, international trade and exchange rate. So this may indicate a policy shift of monetary authority, that is RBI, Reserve Bank of India of the country. And BOP may confirm trend in the economy's international trade and exchange rate of the currency, which means that it would help to have the exchange or the rate of the currency. Now, the general rule in BOP accounting is that if a transaction earns foreign currency for the nation, it is a credit and it is recorded as a plus item. Which means that if I'm exporting and if I'm earning a foreign currency, it is a credit and it is recorded as a plus item. But if a transaction involves spending of foreign currency, it is a debit and it is recorded as a negative item. Now there are various components of BOP statement, that is balance of payment statement. There is current and capital account. So first we need to, of course, there are also other errors and omissions and reserve account, but majorly BOP would have current and capital account, which we would be studying in detail. So current account is a statement of actual receipts and payment in short period. And it includes the value of export and import of both visible and invisible goods. So there can be either surplus or deficit in the current account. Now the current account would include visible, invisible and unilateral transfer. When we say visible item of trade, it means all the goods and services. So export and import of services, invisible items like transport and insurance, and unilateral transfer payments or receipts from abroad or to abroad. Now, when we say unilateral receipts or payment, it means we can take it as a pension or gifts or aids which are exchanged with the other country. Now, BOP on current account refers to the inclusion of three balances: merchandise balance, service balance, and unilateral. Trade balance would have export and import, services again export and import of services, Income balance would have net investment income, that is net income receipt from assets, and net compensation of the employees. And unilateral transfer would mean gift from foreign countries minus gifts to the foreign countries. Now let's understand what is capital account balance. Capital account records all the international transaction that involves a resident of the country concerned changing either their assets with or his liabilities to a resident of another country. So transactions in the capital account reflect a change in stock, either assets or liabilities. So we can say that it is a difference between receipts and payment on account of capital account. In short, it would refer to all the financial transactions. So be it inflow or outflow relating to investments, short-term borrowings or short-term lendings, medium-term to long-term borrowings or lendings. So there can be surplus or deficit in the capital account as well, and it includes private foreign loan flow, movement in the banking capital, official capital transaction, reserves, gold movements, etc. And we can say that capital account can be divided into two categories: direct foreign investment, that is, we can also say direct foreign investment or portfolio, and the other capital. There is also a reserve account. Now, three accounts, that is IMF, SDR, and Reserve and Monetary Gold, are collectively called as a reserve account. Now, IMF account contains all the purchases and the repurchases from IMF. And SDR, that is special drawing rights, are a reserve asset created by IMF and allocated from time to time to member countries. So it can be used to settle international payment between the monetary authorities of the two countries. There are also errors and omissions. The entries under this head relate mainly to leads and lags in reporting of transaction, and it is of balancing entry, and it is needed to offset the overstated or understated component. This is the example wherein we can see that there are receipts and payments. Receipts are on the left hand side and payments on the right hand side. So many times it is very difficult to record all the international transactions accurately. And that is why we have third element of BOP, which is called as errors and omission, which reflects this. Now, there might be disequilibrium in the balance of payment. As I said, payment has to be balanced, which means that all the transactions which are taking place, be it, for example, let's say import or export. So export and import should be balanced. If the import is greater than, if import is greater than export, then it is a negative situation for a country. Again, it is not balanced. It is an adverse balance of payment. Even vice versa, if export is more and import is less, even though it is a favorable situation for any country, but again, it is not balanced. So there might be disequilibrium in the balance of payment. A disequilibrium in the balance of payment means it is a condition of either surplus or deficit. So when there is a surplus, or in the BOP, it occurs when all the total receipts are more than the payment, which is of course a favorable situation for a country, but not balance of payment. So surplus in BOP is when total receipts exceeds your total expenditure, and deficit is when the total payment exceeds total receipts. There are certain causes of disequilibrium in BOP. It could be due to cyclical fluctuations, or it could be due to shortfall in exports, or it could be due to economic development and rapid increase in population, or due to natural calamities and international capital movements, or due to structural changes in the economy. Now, how do you correct this disequilibrium? If BOP is not balanced, which means either of the debit or credit side is not balanced, then how are we going to measure this? There could be monetary measures, like we can have monetary policy and fiscal policy. Now, monetary policy is concerned with money supply and credit in the economy, and central bank may expand or contract the money supply in the economy through different measures. It could be qualitative or quantitative measures, that is general or special measures, like making changes in the bank rate or SLR or CRR ratio, that is cash reserve ratio, or they can also take special measures. Next one is fiscal policy. Fiscal policy is a government policy on income and expenditure, and government incurs development and non-development expenditure. So it gets income through taxation and through non-tax sources. We have already learned what are the direct and indirect tax and what are the sources of revenue, be it through taxation or be it through non-tax. So depending upon the situation, government expenditure may be increased or decreased. Another measure to correct the disequilibrium in BOP is through exchange rate depreciation, which means by reducing the value of domestic currency, government can correct the disequilibrium. Now, exchange rate depreciation reduces the value of home currency in relation to foreign currency. And as a result, import will become costlier and export will become cheaper. So this would also lead to inflationary trend. And devaluation means lowering the exchange value of the official currency, which means when we reduce the value of the currency. Now, when country does or when country devaluates its currency, export becomes cheaper and import becomes expensive, which causes a reduction in BOP deficit. Deflation is again a reduction in the quantity of money to reduce prices and income. And in the domestic market, when currency is deflated, there is decrease in income of the people. Now this puts a crop on the consumption, that is cut down on the consumption, and government can increase export and earn more foreign exchange. Another measure is through exchange control, which means that all the exporters are directed by monetary authority to surrender their foreign exchange earnings, and the total available foreign exchange is rationed among the licensed importers. We can also have non-monetary measures, that is export promotion. So to control export promotion, the country may adopt measures to stimulate exports, like export duties may be reduced so that export can be boosted. Cash assistance, which means again we can give the subsidy so that export again can increase. Goods meant for export can be exempted from all types of taxes. Now that would correct the disequilibrium in BOP. And so in short, export promotion and import substitution. So steps may be taken to encourage the production of import substitutes. So this will save foreign exchange in the short run by replacing the use of imports by these import substitutes. Another method, that is through non-monetary measures, is import control. So import may be kept in check through the adoption of wide variety of measures, like fixing the quota and tariff for import, so that if there is too much of import, then through quotas or through fixation of quotas and tariff, imports can be controlled. Now, under the quota system, the government fixes the maximum quantity of goods and services that can be imported during a particular period of time. And tariffs are the duties or taxes which are imposed on import. So when tariffs are imposed, the prices of import would increase to the extent of tariff. So the increased prices will reduce the demand for imported goods, and at the same time, it will induce the domestic producer to produce more of import substitutes. Now let's understand that what is another concept, that is autonomous and accommodating transaction. Now, international economic transactions are called autonomous when these transactions are made due to some reason other than to bridge the gap in the balance of payment. That is, when they are independent of the state of BOP, which means they are not concerned with the state of BOP. One reason could be to earn profit. So these items are called above the line items in the BOP. And it is said to be either in surplus or deficit if autonomous receipts are greater or less than the autonomous payments. Then what is accommodating? Accommodating transactions are below the line items, on the other hand, which are determined by the gap in the BOP. That is, whether there is deficit or surplus in the BOP. So they are determined by the net consequences of autonomous transaction. Now, since the official reserve transactions are made to bridge the gap in the BOP, they are seen as accommodating item in the BOP. Thank you very much.